Hi, good afternoon, everyone. This is Alex Helms with Mueller Financial Services. I'm one of the wealth advisors here. Wanted to thank everyone for taking their time to join us here today. We're going to be speaking in regards to our webinar of Beyond Money, 3 Key Retirement Decisions. Just a few housekeeping items to first get things started. Just want to make everyone aware that the chat feature is disabled for this webinar. If you have any questions, you'll always be able to reach out via email, as we will share our contact information following the presentation. We do ask that you give us your full attention, as we will not be able to provide a copy of the presentation slides, nor recording immediately following the webinar. We do hope to be able to provide you all with a recording in the weeks following once approved by compliance for sharing. In addition to these handouts, I wanted to make sure that you are aware of some of our brand new podcasts out on Mueller Financial Services LinkedIn as well. You can also find those on MuellerFinancialSolutions.com or anywhere you listen to your podcasts like Apple, Spotify, and etc. Just to kick things off, in case you are folks not familiar with Mueller Financial Services, we are a financial advisory firm. Mueller Financial Services is a financial advisory firm that has served clients for over 30 years, expanding its guidance from the regional to the national level through both growth and acquisitions. We offer a broad range of services for corporations, business owners, executives, independent professionals, and high net worth individuals. Through ongoing education, sound investment strategies, and a strong sense of teamwork, we enter into a dynamic partnership with every single client to best guide their financial investment and insurance planning needs. Since we work independently, Mueller Financial Services is able to bring in partners like Transamerica to come in and help our clients navigate their retirement when facing multiple difficult decisions, such as the 3 retirement decisions today. We feel that it is important to make sure that our clients are getting a well-rounded approach to retirement, which is why we are very fortunate to be joined by such an expert from Transamerica today. While we know retirement has many different factors that play into a successful retirement, healthcare, Social Security, and aging can all drastically affect our retirement within the blink of an eye. But here today, we're here to talk about how we can help plan and prepare for some of these important retirement events. And so I'm pleased to welcome Ryan Bertrand, CFP, CLU with Transamerica, who will provide us with a pathway and some ideas to help us navigate the ever-changing retirement trail. And so with that, I'll hand it over to Ryan Bertrand, if he'd like to share a little bit more about himself and further introduce you to the topic at hand. Ryan?
Thank you. Thank you very much, Alex. I appreciate it. As Alex mentioned, my name is Ryan Bertrand. I am Vice President, Managing Director of the Advanced Markets Group at Transamerica, sitting at the 52nd floor in Denver, Colorado today, and I'm very pleased to join you. As Alex mentioned, I run the Advanced Markets Department at Transamerica, and oftentimes when I mention Advanced Markets, most people have no idea what Advanced Markets is or what the group does, but basically we deal with issues around retirement. We're subject matter experts dealing with all facets of finances. So retirement is a major decision. There's a lot that occurs. The amount of people that are retiring currently is staggering. We tend to hear statistics thrown around a lot, and one of the statistics I hear a lot is there's 10,000 people turning age 65 every single day, and that's supposed to continue throughout the rest of the decade. What that means to me is that there's 10,000 people every single day that are making a lot of very important decisions that are going to impact the rest of their lives. Now, anytime we have a presentation like this, I would be remiss not to go over our disclosures. Words from our attorneys basically says, I'm not a CPA, I'm not your tax advisor, I can't provide you legal or tax advice. Thankfully, I don't think there's anything in this presentation that would be considered legal or tax advice, but have to say it nonetheless. Now, retirement is something that does persist for a long time. The question about how long retirement could potentially last has a great bearing on the outcome of someone's retirement over time. Longevity is one of the main areas that has revolutionized finances and the way people live their lives. You go back to our last major global pandemic, there's been some smaller ones since, but you go back to 1918 and you look at the Spanish influenza and you look at 1918 and how long people were living 1918, it was a completely different world than it is today. The life expectancy in 1918 was a mere 47 years old. So you could expect to live 47 years. Now you look at 47 years today, and people are more or less in their prime at age 47. It is nowhere near being a senior citizen. So you look at 47 years old, and I look at celebrities to put this in perspective. 47-year-old celebrities right now would be Will Smith, Cuba Gooding Jr., and 007 James Bond Daniel Craig. Those individuals aren't even retired. They're nowhere near the end of their lifetime. And the question is, how long are these individuals going to live? Because life expectancy has revolutionized this industry. Life expectancy has revolutionized retirement. You go back to 1918, we wouldn't be having this conversation. One, the technology didn't exist, obviously, but also people weren't living long enough. They weren't living 20, 30, 40 years in retirement. So the question does have to come up, how long can someone live on average? One of the mistakes people make in their retirement planning is they tend to underestimate their life expectancy. Now, we look at the cute baby on the screen in front of me, and you can see the Time magazine cover. This one happened to come from 2015, and the proclamation at the time was that this baby was on planet Earth today and is going to live until age 142. Now, ironically, the very next week after this Time magazine issue was published, there was another article in the Wall Street Journal that said, yeah, 142, that's not right. It's not 142, it's 150. There is a professor out in Palo Alto. So this is an Ivy League professor at Stanford University who proclaims that there's someone on the planet today that's going to live to age 200. Now, I don't know how old someone biologically can live. We can look at the oldest people who've lived on planet Earth from a recorded basis and get a good idea. But right now, the oldest I can recall seeing, and I think if you do the Google search on it, it will show a lady by the name of Jean Clement. She lived to age 122. She was French. And what's interesting about her is by the time she passed away, there was a great debate as to whether or not Jean Clement was herself. There were many people who believed that she had passed away decades earlier and that her daughter was masquerading as Jean Clement in order to collect her benefits and control her bank accounts. So even that individual lived to age 122. The question is, was it even them? There's some controversy around that. Now, also looking at these individuals that live these advanced ages, one of the things that perplexes me is their lifestyle. How do these people make it to these advanced ages? So we look at people that I've compiled through the years, and I found some interesting lifestyles that have made them live this long. And I point a couple out. I read an article that kind of compiled all these, and one of them was a lady by the name of Jessie Gallen. She lived to age 109 out of Scotland. Her secret to longevity and making it to age 109 was staying away from men and eating oatmeal. She would eat oatmeal every single day, which to me sounds a terrible way to live to age 109. And then there's my favorite one, which was Susannah Jones. Susannah Jones was American. She lived until age 117. Her secret to living to age 117 was bacon. She would wake up every single morning, eat 4 strips of bacon, and continue to eat bacon throughout the rest of the day. So I find that a little bit better than eating oatmeal. And then there's Betty White. Most people know Betty White. She passed away, unfortunately, recently, and she made it to age 99. She said her secret to longevity, tongue in cheek, she said the way that she made it to 99 was vodka and hot dogs. Now, honestly, though, if you read a lot of interviews from her, she said having a positive attitude and maintaining humor was a big secret to her longevity. And then there's Richard Overton. Richard Overton, he made it to age 112. He was the oldest veteran alive when he passed away, and he had a very interesting story. So being the oldest veteran alive, he had a military pension, and that was literally the only financial tool that he had keeping him afloat at that age. Now, unfortunately, what happened to him is he was a victim of elder fraud. Someone started rifling through his bank accounts, taking out large withdrawals, basically emptied it. So at the age of 112, he was only able to maintain his independence in retirement because the community rallied around him. Because what's lost oftentimes in these longevity conversations is how expensive it is to make it to these advanced ages. So at age 112, he was spending $15,000 per month to stay in his house. That's $180,000 per year. The community of Austin, Texas rallied around him after he had the elder fraud perpetrated against him, and they saved $453,000 in a GoFundMe account. That's how much he had when he passed away, and that was what was keeping him in his house. Now, I'm not going to say we're going to make it to age 142 or 122 or even 100, but we have to plan for the possibility of living 20, 30, maybe even 40 years in retirement. And the decisions that we make today, the decisions that we make now, are what is going to dictate our quality of life in retirement. And planning for this is extremely important because a lot of these decisions, you only have one shot to make. So we're going to cover today basically retirement in general, but we're not going to focus on the typical things that we think about when we're accumulating. Because I think if you read an article about retirement, oftentimes what you'll find is talking about saving for retirement. And we've done a great job preparing for the saving and accumulation side of it. These are all important things. However, once you transition from accumulation into the distribution phase of retirement, do these really help you out all that much? They do to a certain extent. But when we start to deplete our assets and we start to live off of our retirement savings, these other things become much more important. And a lot of these take a great amount of expertise and a lot of thoughtful consideration when you're going through them. Things like Social Security, things like Medicare, things like estate planning, how you have your affairs arranged. These become much more important when we actually retire and get our gold watch than accumulating to that point in time. So we can't overlook this issue because this is what's defining the modern retirement. So our hope today is to cover these areas, 3 broad areas that everyone has to consider when they're going into retirement, because these are really the 3 key decisions: Social Security, Medicare, so the healthcare side of it, and of course the implications of growing older. And this is a little bit more nuanced, but we'll cover all 3 of these areas. And I think the ubiquitous experience in the American retirement is Social Security. Many people don't consider themselves retired until they actually start drawing their Social Security check. And Social Security, as George Foreman says, I think he puts it very well, it's not necessarily at what age, it's at what income. If you can remember that one nuance, that the age that you collect Social Security dictates the income that you get going forward, it frames it in a much better way. And I think you start to understand Social Security fairly well. Now, unfortunately, when we look at the topic of finance across the United States, what we find is that most people don't make the greatest decisions when it comes to their financial well-being. Now, behavioral finance is a domain that has examined this. And what behavioral finance finds is that people sometimes act in the short-term interest of themselves at the behest of their long-term interest, that they don't always make rational decisions. Sometimes they make emotional decisions, and they don't act like a perfect economic unit. So when we look at Social Security, I think that's a great example of how sometimes people's behavior works to their detriment. Because throughout my career, and I've been doing this for over 20 years, I've seen every year the amount of people who claim their Social Security benefits early. And it's gravitated to the current amount of 71% of people filing their Social Security benefits early, all the way up to around 74% claiming an early benefit. Now, the issue with that is if you take an early benefit, and the earliest you can take Social Security is at age 62, you get a reduction. Now, the key to that reduction, and oftentimes people don't realize this, is that when you take a reduced benefit, not only does it affect yourself, but it also impacts the spousal survivor benefit. And that's a key attribute when we're looking at optimization of Social Security benefits. So you have to ask yourself, with people's behavior, how many people actually file an optimal strategy? And unfortunately, the statistics bear out something somewhat grim. United Planners did a survey of individuals filing for Social Security benefits and estimated that nationwide, only 4% of people who file Social Security benefits file an optimal strategy. Now, what does that actually mean? Because 4% of people, it's kind of an anomalous number, doesn't really mean anything on a concrete basis. You start breaking this down into dollars and cents, and it's pretty profound. We looked at this nationwide, and they found that individuals missed out on $4.3 trillion of wealth just based on filing a suboptimal Social Security filing strategy. Now you take that a step further, because again, that's a nationwide number, doesn't necessarily mean a ton until you put it into perspective. And we put this into perspective on an individual basis, and that $3.4 trillion, sorry, I misspoke, it's 3.4, not 4.3. That $3.4 trillion on a household basis means that just by the way you file Social Security benefits, you're missing out on a household basis of $111,000 of household income. So that $111,000 of household income is a significant number. That's a number that most people in retirement probably wish they had. And again, this is easier than it ever has been because we now have great access not only to advice, but also to technology that can take all of the guesswork out of what an optimal strategy might look like given your specific situation. We can plug the numbers into a computer and get an idea of what an optimal strategy is. So a couple things to keep in mind when we're doing this though. The way Social Security works is depending on what age you file for your benefit dictates how much income you get from the system. So if I file for my benefit at age 62, I get a reduced benefit. If I file at my full retirement age, I get my full retirement amount, which is the amount that pays out at your full retirement age, which is dictated by the year that you were born. Now there's an incentive. You wait after your full retirement age and you will get an increase between your full retirement age and age 70. And that increase is 8% on a simple interest basis. So 8% per year between your full retirement age and age 70. Now, I think I'm having some technical issues. You should be seeing the presentation, but it keeps dropping off. So bear with me just a second. So that option of when to take has a very big impact on the cumulative benefits that you get over time. So putting some thought into this, not only for yourself, but for yourself and your family and your spouse, makes a big difference throughout the course of retirement. And I think if you were to look at Social Security planning and if you were to peg a golden rule on Social Security, one of them might be taking the spouse into consideration. When we look at optimization strategies, many of them rely on the higher earning spouse delaying collection of their benefit until age 70 to get that 8% delayed retirement credit. Because the key in that planning is the survivor benefit is inclusive of that 8% delayed retirement credit. And when you run that number out over 2 lifetimes, statistically, you end up with a lot more benefits. Now, unfortunately, what we find though, is that most Americans are woefully unprepared for retirement. I can remember coming into the industry 20 years ago, and the analogy that was used at the time was that retirement was this 3-legged stool. And you had 3 legs of the stool in order for your retirement to be balanced. So in order for there to be equilibrium, you had to have all 3 legs of the stool at the same length. Now the 3 legs of the stool, 1 was Social Security, 2 was private savings. So how have people done with their private savings? Statistically, if we look at the baby boomer population, the average baby boomer on a median basis, according to the Transamerica Center for Retirement Studies, has saved only $202,000 for retirement. So that $202,000 is supposed to last 20 or 30 years. That's not going to provide a large amount of retirement income. And then the third leg of the stool was defined benefit pension plans. Defined benefit pension plans, the old system was the employer would help fund your retirement and would be one of the stakeholders in making sure that you had persistent retirement income post-death. Now, unfortunately, since the 1980s, we've seen a drastic decrease in the amount of defined benefit pension plans, where now only a segment of the population even has them. But unfortunately, if we look at who can actually get income from all 3 legs of those stools, defined benefit pension plans, Social Security, and private savings, only 7% of the population can draw income from all 3 of those sources in retirement. So what we see is because of those deficiencies, people start taking their Social Security benefits earlier. Now, you ask people why they do it, oftentimes the response that you get, and the surveys will show, the reason they take early is simply because the money was there. Now, I'm not going to say necessarily that that's even the wrong choice. There are circumstances where taking early may make sense, and we'll talk about that here in a second. But oftentimes when we give these presentations, we'll generally have people come up afterwards and say, I took early, I now realize that since I took early, I may have penalized my surviving spouse when I pass away by providing a smaller survivor benefit. Is there anything that can be done to salvage this? And I think a lot of people have this presumption that once you start Social Security, there are no ways that you could potentially increase your benefit. That's just blatantly untrue. There are a few ways that you could increase your benefit. One of them actually is continuing to work. If your current earnings are high enough to be one of your 35 highest years of earnings, that in and of itself will increase your Social Security check. But not everybody's going to do that. So there are a couple other strategies, and they're right on the screen. The first one's called the Payback. And what the payback is I start taking my Social Security benefit. Let's say I take it at age 62, I get the reduction. I decide that I made a mistake and I want a redo. I pay back everything Social Security has paid me. It's called a withdrawal of application. I have 12 months in order to do that. If I don't do it within 12 months, this isn't an option. But assuming I can do that within 12 months and file the appropriate paperwork, they hit the reset button like it never happened. I can then later on file for my benefit when it may make more sense down the road. So the payback is one option. Now, oftentimes people don't want to pay the money back, or maybe they can't, or they missed that 12-month deadline. That's probably the more common one. Is there anything that can be done after that 12-month period to salvage a benefit that was taken early? And there is one other option. It's the start, stop, start. And it also does exactly what it says. You start, let's assume you start at age 62. You have to take your benefit between age 62 if you've activated it until your full retirement age. You cannot shut it off. But when you hit your full retirement age, you do get this new option, and it's called suspension of benefits. That may ring a bell in some of your minds because there used to be this strategy prior to 2015 called file and suspend. That file and suspend strategy is no longer available. However, you still are able to suspend your benefits at full retirement age. And you're probably thinking to yourself, why would anyone ever want to do that? If I'm getting money, why would I stop the checks from coming in? Because if you do stop the check from coming in, and again, this is only available at full retirement age or after, you can then get the delayed retirement credit to come back. So it would then build up the reduced amount by that 8% simple interest each year until age 70. The benefit to that, your check will be higher when you hit age 70, but also when you pass away, assuming you were the higher earner, your surviving spouse will get that higher check. So that's key to a lot of this planning, is protecting that higher earner's benefit, getting it as large as possible so it continues over 2 lives. Now, there's other dynamics as well. I think the need for income is certainly one of them. If you need the check in order to pay your bills, by all means, take Social Security early. That penalty isn't the worst thing in the world. There are much worse outcomes than that. But oftentimes people don't understand how Social Security interplays with employment income. Now, this isn't investment income, so this doesn't include taking money from your IRA or taking retirement income. This is only for money that's subject to FICA. So this is money you get from an employer, and this is a withholding of benefits over a certain threshold. This only applies, though, if you take prior to your full retirement age. You can earn as much as you want or as much as you can from an employer post full retirement age and not have a withholding of benefits. But to dissuade people from double dipping, so from taking Social Security and continuing to work prior to full retirement age, there's this withholding of benefits, and the thresholds are pretty low. So the way this works is if I turn, let's say 63, and I start taking my Social Security benefits and I'm still working, they're going to withhold 1 out of every $2 over $19,560 of earnings. So 1 out of every $2 over that threshold is taken out of my Social Security check. Now you'll notice I say it's a withholding. It's not a fee, it's not a penalty. It's worked back in once I hit my full retirement age and can increase my benefits going forward, but you have to live long enough to recoup it. But that's a low threshold. So if someone's making a large income over that $19,560, that can bring your benefit down to 0. You might not get anything in some circumstances. Now, when you hit your full retirement age, they increase that threshold by quite a bit. It becomes $51,960, and it's withholding of 1 out of every $3. Now, again, after full retirement age, you can earn as much as you want, and they're not going to withhold benefits. Now, another one that I think is noteworthy, and this is crazy. I never thought I'd see this to a great degree, but this is something we see all the time, and it's family situation. We all probably realize that your spouse can qualify for benefits off of your record. When you file for benefits will have a big bearing on when your spouse will be able to collect off your record if that's your circumstance. Now, what many people may not realize is if you are Social Security age and you have kids and those kids are still minors, they can qualify for a benefit off of your record. So by minors, it's basically under the age of 18. And we saw a circumstance like this. We were out in Southern California. We were giving a Social Security presentation, and there was a guy who came very early to the presentation, and he went over his specific scenario with us. It was a very interesting scenario. Unfortunately, he was disabled. He had Parkinson's disease. It was starting to impact his cognition. He was getting a disability from his doctor, and he was determining whether or not he should claim Social Security benefits. So being 62, he knew there was a reduction in benefits if he claimed. Now, when you're disabled, that works different. At disability, you get a forward of the amount that you would receive at full retirement age. And then when you turn full retirement age, it goes from a disability benefit just to a retirement benefit. But what was key in his scenario was not only did he have a spouse, but he had 3 kids, and those 3 kids were still in high school. So we ran the numbers on him, and what we found is if he would not have claimed his benefit at age 62, which you normally wouldn't think would be the typical thought behind claiming benefits, he would not have been able to activate benefits for his kids. So numerically, it was something around $90,000 that he would have missed out on had he not claimed for his benefit at age 62. So you have to take all those relevant variables into consideration, run the numbers, get everything under your circumstance, because it is those specific things of advice that will dictate how much you actually get out of the system and whether or not you're getting an optimal filing strategy. And family situation is a major component of that, as is marital status, as we talked about. Divorce is another one. People need to consider divorce. If you have a spouse that you're divorced from, you can be eligible for benefits off of their record given certain criteria. Now, also, I think the bigger one, though, is health and longevity. And I think this is the game changer when it comes to Social Security analysis. And I think sometimes it's the gut feeling. Family history can be very telling here. So, for example, if everyone in your family dies very young in their 50s, it may not make sense for you to delay your benefits till age 70. If your lifestyle is one that wouldn't be that would be likely to drive a long life expectancy, it may not be best for you to delay until age 70. You might want to take earlier. I use my uncle here as an example. Unfortunately, he passed away earlier this year in February, but I can remember having conversations with him when he was thinking about taking his Social Security benefit. He lived a pretty fast life, didn't have the greatest lifestyle. So I think in the back of my mind and in his mind, he knew he wasn't going to live a long time. Now, unfortunately, he passed away at age 66. He took at age 62. If he had decided to delay until age 70, he wouldn't have gotten a dime from Social Security. So sometimes thinking about your personal lifestyle, your personal family history of longevity can be a great litmus test onto when you should take, because we can take the guesswork out. We know when the crossover points are on a cumulative basis. So here you see these 3 lines. These 3 lines have varying degrees of slope to them. The most gradual line is your age 62-year-old. So that's the dotted line, the circles. That line shows the accumulation for the 62-year-old when they claim their Social Security benefits. 66, that's full retirement age in this scenario. Again, that's driven by your year of birth. But the solid line is the accumulation for someone claiming at a full retirement age of 66. You'll notice that they're eclipsing the age 62-year-old and accumulating more if they were just saving their Social Security benefits at age 78. Now, bottom line, though, is this dashed line. That's the age 70 filer. And again, this is where a longer life expectancy is going to dictate a higher amount of cumulative benefits for those that wait, because you're able to accumulate them faster because they're paying out at a higher amount. So here we'll see the age 82 and a half for someone who claims at age 70 is going to beat the other options, all things being equal. Now, that's a key phrase. All things being equal means different things to different people. It's very important to consider every relevant variable in your situation and get the right advice around Social Security. Sometimes it's counterintuitive. You'll say, I think this is what's going to occur in a filing strategy, but when you plug it in the computer, something completely different shows up. So it's worthwhile to do that. Take the time to do it. It's something, again, that can mean a lot of income in retirement that you're not overlooking. Now, one that isn't as obvious, and this is one that can be very confusing, is healthcare in retirement. Now, unfortunately, when it comes to healthcare in retirement, the American healthcare system is neither healthy, caring, nor a system. According to Walter Cronkite, I think that's a great quote, because this is something that's very confusing. We don't get a lot of information around healthcare in retirement, and you probably get an inundation of information around your 65th birthday because everyone's going to want to try to sell you a Medicare supplement policy. So it's very complicated. You're going to have a lot of stuff coming at you from all directions, and it's something that we tend to see people make mistakes around. Now, it's also something that's very scary. You'll see it is the #1 concern for retirees. And this is something that every year they do these studies, and it's always #1 or #2. It's always jockeying back and forth with running out of money in retirement. So these are things that can scare people. And I think one of the reasons that it scares people is the statistic in the center. $424,000 total lifetime healthcare expenses for a healthy 65-year-old couple retiring today. Now, don't let that number scare you. I think sometimes it can be something that causes some paralysis for individuals because it seems like such a large number. And keep in the back of your mind, the average baby boomer only has $202,000 of savings for retirement. So if you're telling someone that they need $424,000 in retirement and they only have $202,000 saved, it's going to freak them out. Now, this number, though, is a little misleading because this number includes lifetime expenses for two people. So you have two people with the average life expectancy in retirement for a 65-year-old being around 22 years. Now, also, your sources of retirement income can help budget this. We start breaking this number down, 424,000 over two people's life expectancies for 22 years. We break that down to a monthly figure, and we're talking about $800 a month. $800 a month is affordable. $800 a month is something you can budget for. $800 a month can come out of your Social Security check. And in fact, that's how most people pay their Medicare Part B premiums, is from their Social Security check. So we start to look at this puzzle and putting the pieces together, you can see why the Social Security decision has an interplay with Medicare because you're making these decisions relatively around the same time. So you have to think about them in tandem, and they are projected to grow. I think inflation is the hot word right now. We see it at the pump. We see it anytime we're buying an item, and healthcare is projected to continue to grow over 5% for really the foreseeable future. So it is going to get more expensive, and we get sticker shock. We all probably have that experience of hearing someone who went to the emergency room, getting that bill afterwards, or some type of catastrophic health issue, and they get this really large bill to them. I can recall a coworker of mine, his son had the flu a couple of years ago. They went to the emergency room. He was there for 3 or 4 hours, 2 o'clock in the morning. He comes in the next day to work and tells us about it. And he was raving about the fireplace at the hospital. Says, greatest waiting room he'd ever been in. A couple of weeks later, even though they didn't do anything but administer IVs to his son, he said that it cost $12,000. Now, insurance probably covered most of that with his deductible, but still $12,000. And these are things where when we talk about high-end treatments for cancer or for Alzheimer's, we're talking in the tens of thousands of dollars potentially per month in pharmaceutical costs. So this is something that can be very, very scary. Now, I think really when it comes to this, though, just keeping a couple of things in the back of your mind can help reduce some of those fears. One, just making sure that you have the insurance for the catastrophes. That's what it's there for. It can cover a lot of it. 2, budgeting. Making sure you have this budgeted properly in your financial plan can help with some of these expenses. And then finally, 3, making sure you're signing up for things on time and it's the right type of coverage. Because oftentimes people don't realize how Medicare works when you have to sign up for it. If you're not working, you have to sign up for Medicare within the 7 months bracketing your 65th birthday. So you can see the month you turn 65, your window opens up 3 months before that and 3 months after. So you have a 7-month window to open up, but that's not true to everyone. Now, if you fail to sign up during this window, you get late enrollment penalties. So that's a 10% cumulative penalty on top of your Part B. Also, you have a penalty for prescription drug coverage if you don't sign up for it in time. But also, this doesn't apply to everybody because I mentioned if you're still working and you have creditable coverage from your employer from working, you don't have to sign up during this period. Instead, you can sign up once you lose that creditable coverage. So that's a key element. If you get a notification from your employer and it says creditable coverage, that means you don't have to sign up until you actually separate from service and lose that health insurance coverage through your employer. Now, the good news too is your spouse may not have to sign up if they're a dependent insured on that creditable coverage. So you can see there's some moving parts here. What we really want to avoid is disjointing in ages, especially between spouses, because the scenario we oftentimes see is we'll have a working spouse, they'll retire at age 65. The younger spouse, they're age 62, they don't have employment, they don't have health insurance of their own, and when that 65-year-old retires, guess what happens to the coverage for that 62-year-old? You get COBRA, but COBRA is extremely expensive. Once the employer is no longer subsidizing it, you might have some sticker shock and it may not be affordable to continue it. Other than that, though, you'd have to go out and get your own insurance because unlike other aspects of our retirement system, Medicare is an individual benefit. You have to sign up for it separately as a spouse. So keep that in the back of your mind. And if there are age differences between spouses, you need to account for that to make sure that you don't have issues around one spouse not having insurance or needing to go out and get it. Very important aspect to this. So my recommendation is anytime you're turning 65, 6 months before that date, go in and talk to your employer if you're still working to see how they approach Medicare. What they're probably going to tell you is, we might want you to go on Medicare Part A because Medicare Part A is free. Once you're Social Security insured, you don't pay a cent for Medicare Part A. So a lot of employers will want you to go and sign up for Medicare Part A because it provides some additional coverage for hospital. Now, if you do that, you want to make sure that you stop HSA contributions because you're not eligible to make an HSA contributions within 6 months of being on Medicare Part A. So there are some interchanging things that are somewhat arbitrary that you would need to take into consideration. But again, go in around 6 months before your 65th birthday if you're still working and ask HR what they want you to do about Medicare. Also, Medicare doesn't cover everything. And if you look at Medicare, when it was originally launched in the 60s, it only covered 51% of medical needs. Now, some of these things you read through the list, it's pretty obvious that they can be medically necessary. So dental, foot care, those are things that you can think about as medically necessary, but they're not covered in original Medicare. So part of the issue around Medicare is you get choices. And anytime we interject choices, it makes things more complicated. And when we have this complexity, it requires some thought. So we have to consider the choices that we have around Medicare, because as this has evolved and built out over time, they've added things to the program to fill in some of those gaps and some of the things that aren't covered. So here we have two broad options. So you see that top set of dots? That's called original Medicare. So when you hear original Medicare, we're looking at this option. You have a second option, which is Medicare Advantage. That's the circle on the bottom. So if we go with original Medicare and you just sign up for original Medicare, you're getting Medicare Part A and Medicare Part B. Medicare Part A is for hospital coverage. Medicare Part B is for outpatient services like going to the doctor. Now, again, wasn't covered initially, but pharmaceuticals are an important part of our healthcare needs, having the right medicine. So they added in Medicare Part D, which is prescription drugs. And then finally, to fill in other gaps, they added in Medigap policies, which are standardized policies that are available in states to cover medical issues. Now, the bottom dot is an altogether different option, Medicare Advantage. Medicare Advantage you can think of as the one-stop shop. You buy one policy, it covers everything. You don't have to buy a Medicare Part D policy, you don't need a Medigap policy. Now, it doesn't necessarily mean it's better. So one of the things that drives me crazy and one of the biggest mistakes in planning around Medicare is I like Medicare Advantage because it's provided by private companies, it's simple, or I like original Medicare because it's provided by the full faith and force of the United States government, and I like the government provided relative to private insurance, or vice versa. People have very strong biases against anything either provided by governments or by sorry, my computer is glitching again, or by private insurance. It's probably the worst way to make this decision because I don't want anything provided by the government may not be pertinent to your specific situation, or I don't want anything provided by private insurance companies. Insurance companies are the devil. That is really immaterial to what is actually being provided under these policies. Some critical thought needs to be put in place. So what type of things are we looking at? Cost is a big one. You can see original Medicare versus Medicare Advantage. Generally, Medicare Advantage is going to be a little less expensive, but that's not the only variable to take into consideration. I would really say for anyone thinking about the Medicare enrollment decision, first add up all the costs. So make sure you understand how much one is going to cost versus the other, and then understand the advantages between the two different systems and which one might be better for you. I think this chart can be really helpful because this frames it in a way that puts things into perspective. Medicare Advantage are private insurance companies that are operating likely as an HMO or PPO. So if you keep that in the back of your mind, you can kind of get an idea of what it is because you probably have experience with HMOs or PPOs from the private sector. Now, one of the best questions to ask is which one does my doctor take? Is my doctor part of that HMO or PPO? Or conversely, does my doctor accept original Medicare? Because they may be part of a Medicare Advantage system, but not want to take original Medicare? To me, that's the most important question to ask, because it's unrealistic to think someone, just because they're turning age 65 or retiring, is going to switch doctors, which sometimes people go to their doctor for decades. And all the information that you go through with your doctor is lost if you have to switch because you go to one system of Medicare versus another. So that is the most important practical application question. Which one does my doctor take? Now, if your doctor accepts both, then you have some thoughts to put in consideration. Now, I think travel has to be another thought. Are you going to stay in your region, or are you going to travel across the country on a regular basis, maybe to visit family or grandkids somewhere else? If you're going to do that, make sure if you go with the Advantage system that you have access to medical care at a reduced cost basis in that region, because some HMOs, some PPOs can be very small regionally. They may just be in the Northeast, but let's say your grandkids live in California. You might not have access to a doctor in that network in California. So your Advantage plan, I would say, is only as good as the network that's standing behind it. So keeping that in mind can help. Now, with original Medicare, it's accepted in any state to any doctor that accepts original Medicare. So that's also something that needs to be thought about. Now, also another thing that needs to be taken into consideration is, do you have any special situations? Do you have any special medical needs? There are Advantage plans that will cater to special medical needs like end-stage renal disease, dementia, Alzheimer's, diabetes. If you're in those types of situations, you may want to go with one of those special needs plans through Advantage, because you might be able to get more robust coverage than going with original Medicare. Also, out-of-pocket expenses is another big one. You'll notice in Advantage plans, there's a maximum out-of-pocket amount, whereas in original Medicare, unless you have supplements, you have more or less an 80-20 insurance plan, with the 20% being an infinite amount. So putting those critical thoughts into place, recognizing that there's more important attributes to which one you sign up for, whether it's government provided or private insurance provided, that is really immaterial. Both systems, they have attributes that are government provided and private insurance provided. You can't separate the two. So making that decision just based on something arbitrary can be a big mistake. Another thing that Medicare does not cover, and most people don't plan for, is long-term care. Now, long-term care might be one of the most expensive things that most people will need throughout their lives. You look at the cost of long-term care, and you'll see semi-private nursing home room was $94,900 last year, and we compare that to other expenses. The only thing I can think of that's even close that you're going to need for a similar duration is higher education. Now, what's crazy is you could go to the most expensive Ivy League private school and still pay less than 1 year in that semi-private nursing home room. The most expensive college is, depending on the source you look at, is Harvey Mudd College in California. Scripps College will come up on some lists. George Washington comes up on another. Those institutions all in generally are still under $80,000, around $78,000 per year. Now, we know, according to Health and Human Services, that 66% of people over the age of 65 will need long-term care at some point in their life, and the average duration is between 3 and 4 years. So we know that higher education and long-term care look very much alike. And you think about the amount of time people spend planning to save for their kids' education relative to their own long-term care, and they'll put a lot of effort into education, but nothing into their own long-term care. So this is something where just having it on the top of your mind may put you well ahead of your peers. Just having savings, just having something like an insurance policy can make all the difference if you do go through long-term care. It does vary on state as well. Alaska is the most expensive state for long-term care, and it's north of $300,000 per year in the great state of Alaska. So it can vary quite a bit when we're talking about long-term care expenses. So just make sure that you account for these, because Medicare doesn't cover it at all. Now, of course, the sources are personal savings, private insurance, and Medicaid when we talk about long-term care discussions. But I think when it comes to healthcare, just make sure you address this, make sure you budget for it, and that you have some savings to cover expenses for healthcare and potentially long-term care needs. And then, of course, understand what's best for you. The final area we'll run through really quickly is aging. Age is an issue, mind over matter. If you don't mind, it doesn't matter. It's a quote from Mark Twain. Now, note at the very bottom, Mark Twain is not affiliated with or endorsed by Transamerica. Yep, That's actually a disclosure we have on there. So aging. When it comes to aging, I think if you cover these 5 areas, this was something we put together with the MIT Age Lab. So MIT is a think tank out in Boston, Massachusetts, very highbrow Ivy League institution. Guy by the name of Dr. Joe Coughlin runs their Age Lab. And we put this together in tandem with a seminar and robust collateral around what to do around aging. And what we found is intentions is the best place to start. So that's the very center. Intentions are, what do you want? What do you want to have happen will dictate what's out on the wings of this spectrum. Income insurance, banking administration, personal assets, and care management. I think all of these are very important to take into consideration. Personal assets, we're thinking about consolidation. Income and insurance, we want things on autopilot. Banking administration, making sure bills get paid and that our money is managed if something catastrophic like a stroke or dementia or Alzheimer's happens to us. And of course, the qualitative side, where do we want to live? Who do we want to have take care of us? And then budgeting for these things or thinking about them, because as you get older, of course, you become more prone to chronic conditions. One that is very affiliated with age is Alzheimer's and dementia. And we can look at the statistics and you can see the biggest variable on a dementia diagnosis or an Alzheimer's diagnosis is age. So think about 65-year-olds. 1 in 10 65-year-olds will have an Alzheimer's or a dementia diagnosis. You go to age 85, it becomes 1 in 3. We all probably have a story or know someone who's gone through dementia, cognitive impairment, or Alzheimer's. Now, the key here, though, is you don't want this to sneak up on you. Because I remember 2nd grade, we moved to Sioux Falls, South Dakota. We had neighbors who were elderly. And unfortunately, what happened was he got struck and killed by a drunk driver when I was in high school. She had Alzheimer's. And the next day, she disappeared. They didn't have family. They didn't have a support network. Likely didn't have a financial advisor or a legal team to tell them what to do. What probably happened to her is she probably ended up in a care facility as a ward of the state. Because what happens if you don't have the directives is you go through conservatorship guardianship. So conservator guardianship are set up for someone else to take care of your affairs, both healthcare and finances. Now, if you don't want to have that risk of someone else messing that up, you need to have the right directives in place. This is inclusive of wills, advance directives, POAs. If you have those in place and you become incapacitated, because something like Alzheimer's is just a matter of if, or sorry, it's not a matter of if, it's a matter of when. We know at some point that someone with an Alzheimer's diagnosis will lose their capacity. Now, legally, when that happens, you want to make sure that you're safeguarded. And these types of forms are what are going to dictate when the plan comes to bear, how things flow down. Now, unfortunately, what we find is this is a very complicated area. So just understanding this, making sure you get the right documents in place to safeguard you from this means all the difference. And then, of course, having things set up for your family so there isn't the chaos that ensues when you pass away and the family becomes infighting. That's why we have estate planning. Making sure your affairs are lined up to cause the least amount of chaos, expenses, and taxes is really the goal of this. And this has a big impact on families down the line. So aging, make sure you talk about it, review, have the right type of directives in place, and then finally communicate it. You can have the best laid out estate plan, all the right documents, but if you don't communicate that with your loved ones, that can cause a big issue when it comes time to execute it. And this is where having the right team is extremely important. I think currently in our environment, there's so much information. You think about all the time you spend on your phone, that phone is only going to help you provide so much information. At some point, you need financial professionals that have expertise in all of these areas to help you make the right decisions. Because again, these are long-lasting lifetime decisions that impact you and your family. So I know that's a ton of information, and I really appreciate everybody attending. And I'm going to pass it back over to Alex for some closing thoughts.
Yeah, first of all, I just wanted to say thank you all for attending today, and thank you, Ryan, for a great presentation. I found a lot of value in it myself. Just wanted to let any of you folks know if you have any further questions about today's topic or would like to learn more, please contact Ryan or myself. We'd both be happy to speak with you about your individual situation and address any follow-up questions you may have. Again, just wanted to say thank you for everyone for attending, and that'll be the close of our presentation today. Thank you very much.